All right, let's dive right in. Today, we are tackling one of the most fascinating and honestly kind of mystical tools in a trader's toolkit, Fibonacci. It's this incredible bridge between the beautiful, predictable patterns you see in nature and the wild, chaotic world of the financial markets. We're going to break down exactly how it works. So it all kicks off with a really simple sequence of numbers that, weirdly enough, shows up everywhere. You see it in the spiral of a massive galaxy, the way seeds are arranged in a sunflower, even in the curve of a seashell. It's like nature's secret blueprint.
And this is where it gets interesting. These exact same mathematical ratios also pop up again and again on financial charts. Traders believe they can actually use this pattern to predict where the market might turn. It's almost like they found a secret code hidden in the price.
That's the billion-dollar question, right? How on earth can a pattern from a flower or a seashell have anything to do with the stock market? Well, that's exactly what we're here to figure out. So, to really get a grip on why this works in trading, we've got to go back to the beginning. We need to look at where these numbers actually come from and then connect the dots to see why they're so relevant in the world of finance.
The whole thing is built on the Fibonacci sequence, and it's so simple it's beautiful. You just start with 0 and 1. From there, every new number is just the sum of the two that came before it. So 0 plus 1 is 1. Then 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, and it just keeps going, building on itself forever.
Now, here's the magic trick. Traders don't actually use those sequence numbers directly. What they care about are the powerful ratios between the numbers. If you divide any number by the next one in the sequence, you always get pretty close to 0.618, or 61.8%. And if you divide it by the number 2 spots ahead, you get 38.2%. These percentages become the critical levels traders watch on their charts.
So, why does this actually work? Is it some kind of cosmic force? Not exactly. It's really all about math psychology. The truth is, so many traders and so many trading algorithms are all watching these exact same levels. It becomes a self-fulfilling prophecy. When the price gets close to a key Fibonacci level, everyone expects something to happen, so they place their trades, and that collective action is what creates the reaction. Okay, so theory is one thing, but how do we actually use this? How do you take this mathematical idea and slap it onto a live trading chart? Let's get our hands dirty and look at the practical steps. Let's say the market is going up, an uptrend. It's super simple. First, you find a clear bottom, the start of the move. Traders call this a swing low. Then you find the top of that same move, the swing high. You just click your tool on the low, drag it up to the high, release, and boom. The software automatically plots all those key percentage levels for you. And if the market's falling, you guessed it, you just do the complete opposite. You find a major peak, a swing high, and then the valley that follows it, the swing low. This time you draw from the top down to the bottom, and the levels will appear above the price, showing you potential spots of resistance. Now here's a quick pro tip that'll make your levels way more accurate. Always, and I mean always, draw your lines from the absolute highest high to the absolute lowest low. That means using the very tips of the candlestick wicks, not the bodies. That way you capture the entire price swing. And stick to the big, obvious moves. That's where Fibonacci works best. Okay, so you've got these lines on your chart. Now what? They're just lines until you know how to read them. So let's decode what these levels are actually telling you and how you can spot the high probability hot zones. Think of each level as telling a story. If the price only pulls back a little bit to the 38.2% level, it's telling you the trend is super strong and raring to go. A pullback to the 50% line is a big deal psychologically. It's the halfway point. But a deep pullback to the 61.8% level, that's often considered the prime spot to look for a major turnaround. And speaking of that 61.8% level, let's give it the spotlight it deserves. This is known as the golden ratio. It's a number that shows up all over nature, art, and architecture. So in trading, it carries a special weight. When a price pulls back to this exact level and bounces, traders see it as a very, very powerful signal that the trend is about to get back on track. But here's where we move from the basics to a more advanced strategy. Just using Fibonacci levels all by themselves can be a bit risky. Their real power gets unlocked when you start combining them with other tools. You know, a good way to think about it is this. A Fibonacci level is one piece of evidence. It's a clue, but you don't want to make a big decision based on just one clue, right? You want to find other clues that all point to the same conclusion. And that's what we call confluence. This is the holy grail. It's when a key Fibonacci level, like our friend the 61.8%, lines up perfectly with something else on the chart. Maybe it's an old support line or a major moving average. When you get multiple reasons to pay attention to one specific price zone, that area becomes a high probability hotspot.
And this is absolutely crucial. So please remember this. You never, ever enter a trade just because the price touched the line. You have to wait for confirmation. You need to see the market react. Look for a candlestick pattern, something that tells you, hey, other traders see this level too, and they're buying. That's your green light. It confirms the market agrees with you.
Okay, so finding a good entry is awesome, but it's only half the game. You also need to know when to get out and take your profit. And you guessed it, Fibonacci can help with that too.
For this, we use a tool called Fibonacci extensions. So if retracements help you get into a trade, extensions help you figure out where to get out. They project forward to show you potential price targets.
These are some of the most common levels traders use to set their profit targets. That 161.8% level is a really big one. It's a common target for traders after a price bounces off a key retracement level. It just gives you a logical place to aim for instead of just guessing.
So let's wrap this up with the golden rules. 1. Only use this tool on big, obvious market swings, not the little choppy noise. 2. Always, and I mean always, wait for the market to confirm the level before you jump in. And 3. Nothing is a sure thing in trading, so always use a stop loss to protect yourself.
Which leaves us with one final, kind of mind-bending question. Does this all work because the market is some kind of natural organism that follows these universal laws? Or does it only work because millions of us all around the world believe it works, and our belief is what actually bends the market to these patterns? Something to think about.